All right. Welcome, everybody. Thank you so much for joining us today. Have a super special guest that I am personally, selfishly, I'm looking really forward to hearing from because I'm always looking to get a more education on taxes and how to pay less of them, of course. So that's kind of the topic of today with a bunch of detail mixed in. But wanted to start just a couple minutes early because we have so much information, and I this will be recorded, so whoever's not here will hear this later. But there's only a few of you guys right now. Stephen, it's good to see you. Stan, thanks so much for joining us. If you too, as more people join, because we're still a minute early, if you too have any questions, please feel free to type them into the chat. I do have some that we'll ask at the end that were pre-submitted, but definitely as the conversation is going, please, if you think of a question, type it in so that you don't forget what that question is. And let's see, we've got a few more people joining the waiting room. Selena, welcome. If you guys could type into the chat where you're kind of tuning in from, I'm here in Orange, California, about 15 minutes from Disneyland. Where are all you guys coming in from? That'd be cool. And then also, if you can, just type into the chat maybe what you're hoping to get out of this webinar today. What maybe main takeaway do you want to walk away with? That'd be cool to kind of hear about as well. And okay, Louisa, if you could just keep letting people in, I'm going to share my screen so I can start because I want to, like I said, as soon as possible, I would like to get out of the way and let our main event speaker kind of take over. If Zoom would give me the option to share the right screen, that'd be sweet. There it is. All right. Okay. Well, we are here to talk about real estate tax moves that actually matter. And the title today is What Investors Need to Know About Status, Depreciation, and Exchanges. It's going to be jam-packed. So again, I'm going to talk quick. I'm going to get out of the way and let Nicole take over here after I introduce her, of course. And my name is Brett. I'm a consultant here at Sense Financial. And by the way, this is not, and I'm sure Nicole will have her own disclaimer. Sense Financial is not a fiduciary. We don't provide legal or tax or accounting advice or any other professional advice for that matter. Our specialty is in establishing and creating the self-directed checkbook IRA and the solo 401k. And that is our profession. If you need services in any other category, please reach out to that proper professional. We've been around since 2010. All of our plans come with what's called checkbook control, which many of you on here are clients, so you know exactly what I'm talking about. But if you're not, it just basically means that you don't have to go through the custodian to perform any transactions, any investments. You control the funds, you control the investments. You're the fiduciary of your plan. And so your job is to invest it wisely and aggressively, but you have the power to do that without going through anybody else. That's what checkbook control is. We've been around since 2010. We have 5-star reviews all over the place. And to date, we've assisted over 7,000 clients set up over 8,000 self-directed retirement plans. And most of our clients come from referrals, and most of those referrals come from our existing clients. So keep them coming. We appreciate it. And the ability to have what's called true diversification is the benefit of setting up a self-directed retirement account, IRA or 401k. The IRS, I'm just going to leave it at this. The IRS allows you to invest in anything except collectibles, life insurance, and an IRA. And you need to make sure that you're not committing a prohibited transaction by investing with a disqualified party. Basically, keep you and your immediate family out of the picture, investment only, and no collectibles, no life insurance, and you'll be fine. The returns can either be traditional or Roth, and you can actually get a loan when it comes to buying real estate. You can get non-recourse financing to buy more real estate. We talked about checkbook control. The solo 401k really is a true tax shelter, and I apologize, I need to update that amount. The contribution for 2026, if you're over 50, is actually 80,000, and that even goes up higher with the super catch-up if you're 60, 61, 62 in that tax year. But if you're under 50, it's $72,000 for 2026. Okay, so solo 401k is amazing. I talked about the unlimited investment options already, and just true diversification. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, or you do not know what misfortune may occur on the earth. And that was short and sweet. If you're just joining us, please type in your questions in the chat. I'm going to introduce Nicole here, and then I'm going to get out of the way. Nicole Green is an enrolled agent and NTPI fellow with nearly a decade of experience helping individuals, real estate professionals, small businesses, startups, influencers, healthcare providers, and educators navigate complex tax matters. She holds a bachelor's degree in education from San Francisco State University and a master's in education and educational theory from UC Berkeley Walden University. A member of both the National Association of Enrolled Agents and the California Society of Enrolled Agents, Nicole is federally licensed to prepare tax returns and represent taxpayers before the IRS. Her expertise has been featured in outlets including the Wall Street Journal, Homelight, and Impact.com. Outside of work, Nicole is an avid traveler who has visited all 7 continents and more than 50 countries. Check that out. And she enjoys exploring new cuisines, attending sporting events, and discovering new experiences around the world. Nicole, thank you so much for being here. Love your accolades, by the way. Good job. Congratulations on all the education and travel, and that's great. So we're looking forward to hearing from you, and I'll let you share your screen and kind of take over from here. But just as a reminder,
Thank you
if you're
so
joining,
much for having me. I
yeah, no worries.
appreciate
Please,
I
if
appreciate
anybody
it.
has questions, type them in. Don't forget. Okay. All right. Thanks, Nicole.
I want to first say sorry that I am not dressed appropriately. Today is just World Cup Day, and attending sport event is a big thing for us here. So, what I had to represent as somebody that used to live in Argentina, I just had to represent my peoples. But okay, let's talk about tax. We're going to go into I want to show today some strategies. I want to give people some examples so you can see that you have options. I mean, that's really the true definition of wealth, is to say and to have options. It's not really to just like buy all the crap. It's to decide and be able to buy all the crap and decide if you want it or not. As mentioned, I work at Robert Hall and Associates. We are a tax firm. Robert Hall and Associates was started by an educator. I used to be an educator, and people think like education tax, that's so weird, doesn't really translate, but it actually does, because that's all I do all day is I educate people via webinars, I educate via my clients, my support staff. It's just a very niche specific topic that I'm educating on. And I am constantly learning because our tax laws are constantly changing. We saw a big change this last year with the One Big Beautiful Bill. We're going to see another big change probably in about 5 years with whatever president we end up having. And that's part of the fun about the taxes, is that there are constant changes. And so what you have done maybe 10 years ago isn't necessarily something you can or should be doing now. You should make your tax returns like work with you, and that's what I want people to like really kind of take away from this, is that it's not going to be a black and white situation. There's many different strategies that people can use. And it's all about you maybe layering or deciding what best fits with you. And so I just want to kind of bring that home. I can talk about tax all day. I don't mind talking about tax. When people find out that I'm an accountant, they always are like, I have a question. It's like accountants, doctors, attorneys, and maybe mechanics, that people are like, "Oh, wait, you do this for a living? Can I ask a question?" And like, I don't mind. People find out about me being an accountant in the grocery store, and they'll ask me a question. But my first question back is always, usually, is going to be how much, and that could be quite personal. And so that is one of the reasons why we offer these free discovery calls, so that you can get the questions out and we can talk about it on a personal thing, because nothing is blanket. I'm sure there's always that story of, well, my coworker makes the exact same as me, but their tax situation is different. Why? And it's more layered than that. And so we can get into specifics. If you would love a discovery call, please scan the QR code, or you can send me an email, nicole.green@roberthalltaxes.com. I'm also going to open it up for questions at the end. That's kind of like we were going quick in the beginning, is so that we can make sure that we have time for questions. So feel free to hit me up with questions. Of course, this is purely educational and licensed by the federal government. We work locally here in California, and then we also work nationwide and a little bit internationally, but this is just purely meant to be educational. Okay, Let's get into some of the examples. So there's several things that you can do as real estate investors, and we're gonna this these examples here are all kind of specific to real estate and real estate investing, so people could understand these types of strategies. There's many other types of strategies that people can do, but we just wanted to pick something very specific that would be appropriate for you guys, and this is how what we came with. And so one of the big strategies is real estate professional. People like to implore real estate professional, which is an election that you can make. Now, we need to understand about rentals. I have several rentals. Like me and my family, we have like 64 rentals, and I am an accountant. And rentals generally are going to show losses on your tax return. That is completely normal. That's kind of what you want. That's the whole, or not the whole, but that's the main giddy up of rentals, is that it's really tax free money coming to you. You want your rental to cash flow, but you, on your tax return, you're not going to be paying taxes on them. So rentals show losses. These losses are passive because rentals aren't daily, right? And so passive losses don't go against active income. And so generally, people like me, we're going to have just a bunch of losses that we're carrying on our tax return. If you're a real estate professional, it makes no sense for your losses to be passive because this is actually your career. This is something you are doing day to day. And so it makes, when you elect to have the real estate professional status, you are saying, hey, my rentals should be active, they shouldn't be passive. They allow your losses to go against any types of income. So now it could go against W 2 income, it could go against retirement, it can go against any types of income. It's totally free. And not just necessarily yours. If you have a spouse, it can go against the spouse's income. And so that could be a really huge benefit. However, with all things, there's good and bad sides to the coin, right? And so real estate professional does attract extra attention. I call it attention because it doesn't mean it's going to guarantee an audit by any means. It just attracts attention. And so, one, when we're deciding if you should go real estate professional, I always make it very clear that we need to make sure that the benefit outweighs the risk. If your rental is showing a $5,000 or $3,000 loss, like why are we attracting extra attention for maybe a couple $100 of tax savings? We want to make sure that it actually makes sense for you. The reason that it attracts attention is because you're just claiming it. It's just a box that people are checking. And so a lot of times people use it incorrectly. And that's why the government is like, wait, do you actually qualify to be real estate professional? So let's talk about the qualifications. There's three rules for people that are claiming real estate professional. You must meet all three of these requirements, not one of the three, not two of the three, three of three. The first thing is the majority of your earned income needs to come from real estate. And so this one is really, really big because I had a client, my client did like coding or something, and he was getting really into real estate, and he was like, hey, I want to be a real estate professional, but his W2 was more than what his single rental was producing. And so I we couldn't have him be the real estate professional. His amount of time he spent working was less than the amount of time he spent on real estate, but his W2 was more than that. So he couldn't qualify because you need the majority of your earned income to come from real estate that you own. And this could be also, if you're a broker, it doesn't need to be like the actual rental. It could be just something that is centered around real estate. If you're a real estate attorney, if you're a broker, if you're a transaction coordinator, if you're a designer, like if you're a stager, like, there's all of these types of architects, whatever. There's all types of industries that are real estate specific, and your majority of your income needs to be from real estate. The next is you must meet the material participation rules. And this really comes down to being roughly about 10 hours a week. It's 750 hours a year. This is the easiest one. This is absolutely the easiest one for people to meet. And I'm not generally not super concerned about people qualifying in for this one because, like, looking for a rental, attending a class like today, all of these things, they all count in terms of hours. And so the material participation, very, very much an easy one to meet. The last one is the majority of your working time needs to come from real estate. And so that means the majority of your effort and the majority of your money needs to come from real estate that you own. Doesn't mean you need to work full time, but it just means that the majority of the actual time that you are working is coming from real estate. Again, it could be from anything, you being the architect, you having a staging company, like whatever it may be. If you meet all three of these qualifications, then you can go ahead and claim real estate professional. Okay, so let's get an example of what real estate professional actually can look like. In this case, we have a husband and wife filing, and they have some rentals. The rentals were showing some loss. They had two rentals, and the rentals were showing losses. The wife was not, did not have a W 2 job. And the husband did have a W 2 job. And we said, let's see if the wife can qualify as real estate professional. The real estate was also in the wife's name. And so here, before they were qualifying, without qualifying as real estate professional, they were showing total income $259,000. Their total tax was almost 24. We really pay attention to total tax as opposed to like refunds or if you owe or something like that, because you want to pay attention to the total bill. So then once we were able to get the wife to qualify as real estate professional, they're now able to use the losses that they had. These were losses that they weren't able to use. They didn't lose them. They were just going to carry them forward until they were able to use them. Now they're able to use them with the wife qualifying as real estate professional. They take in a single year $37,000 of loss, and that drops their tax to 14,500. They're saving about $9,000 on the federal side, and also they save on the state side too. But my example is just showing it on the federal side. They're saving $9,000 by just using this status. They didn't do anything extra. They're just using this status change. And so, again, real estate professional can be a really nice benefit if you can qualify or somebody does qualify, and then it can make real big sense. Sometimes we have it where somebody will qualify as real estate professional 1 year, but then the next year they're not qualified. Maybe somebody gets laid off or somebody goes on maternity leave or you're changing jobs, and now it makes it so that you can qualify, or you decide to qualify 1 year but it doesn't make sense to have that attention because you don't have the losses the next year. You can decide, just because you have the status 1 year doesn't mean you need to keep it going every other year. That's kind of one of those important things that I wanted to mention. Now, let's say you can't qualify for real estate professional. Like me, I can't qualify for real estate professional, even though I am a ton of real estate. I can't qualify because I work a lot here as an accountant. And so, one thing that you can do is if you have a short term rental, short term rentals allow for it to be active income because short term rentals are more attention, right? It's short term, people are turnover. And what you need for something to be considered a short term rental is you need to offer a daily service. Doesn't mean somebody needs to elect to have said daily service. You just need to offer it. And people generally pick things like cleaning or transportation. And of course, it could be at charge. It doesn't need to be free here. It could be absolutely at charge. But you having this daily service now is showing that it is a short term rental and also needs to be able to be rented out 7 days, less than 7 days. People can rent it more, but you need it to be able to be rented for less than 7 days as well. So once you do that and you have your short term rental, you can take your rental not as passive, but you can put it as business income and take it as active. And when you're able to take it as active, here in this example, we can see this $11,000 loss is being used. Now, Passive losses can also be taken if your income is less than $150,000 married filing joint. If your income is less than 150, you can take a little bit. If your income is less than $100,000, you can take up to $25,000. And so here in this case, by them taking this business loss, they're able to also take a little bit of passive losses. So one of the rentals we're having as a short-term rental, and then the other rentals, you're just able to use some of these passive losses coming through. And so if you have short-term rentals, I personally don't have short-term rentals, but if you do have short-term rentals, it's a really nice way to be able to use some of like all of your hard sweat tears in the actual year that you're having it happen. And then again, if you have a short-term rental 1 year and then you decide to change that short-term rental to a long-term rental, you absolutely can. Nothing is like set in stone. One of the other really great things that you are able to do is with a cost seg. A cost segregation study really helps people give options of how much depreciation that they want to use. And so depreciation, I always make the joke that depreciation is like a beautiful woman where you can absolutely just, she can do absolutely everything for you. But if you don't really pay attention to her and you ignore her, she'll come back and smack you in the face. Like, because depreciation is absolutely heavenly, except if you forget about her. And so depreciation is where you take the expense that you paid for an item and it gets spread over a period of time. And so, like, if I have a car, right? I bought a car for 100,000. Cars are depreciated over 5 years. And so essentially, I'm getting $20,000 of a deduction every year. The amount of time that it is spread over is predetermined. Your accountant doesn't determine it, you don't determine it. It's predetermined by the general accepted accounting principles, GAAP. And so everybody follows the same rules. So rental properties are depreciated over 27 and a half years. 27 and a half years does not allow for bonus depreciation. Bonus depreciation is where you can go into the future and you can pull your depreciation forward. So, for example, a car, I depreciate that over 5 years, it is eligible for bonus depreciation. I paid $100,000 for this car. If I want to take that $100,000 deduction in the first year, I can with bonus depreciation as opposed to $20,000 every 5 years or every year for 5 years, excuse me. And so a house is 27 and a half years. It is not eligible for bonus depreciation. Things that have a 5 year, 7 year, 10 year, and 15 year time frame are eligible for bonus depreciation. A refrigerator is eligible for bonus depreciation. Windows are eligible. So, what people have done is they go around and they do a cost segregation study. And that's where they take the expense of the house and they itemize it. We're not just looking at the house at $1 million anymore. We're looking at, nope, the carpet is worth $30,000. The toilets are worth 8,000. I don't know. Actually, nowadays toilets are quite expensive, but whatever, I digress. But they're going through and they're itemizing. You're getting a professional to go through and itemize the things in the house. And those things also have different timelines. So, roughly, you're going to see that about 30 to 60%, depending how your house is structured, is eligible for bonus depreciation. And so that means you can go in the future, grab your depreciation and pull it forward and take it in the first, second, and third year that you put the house in service. The third year that you decide to rent it out or you're using it as investment, whatever, the third year that it's generating some revenue. And this can be absolutely advantageous. So in this example, this person has two rentals. One of the rentals is super, super old. It's been almost fully depreciated. That's part of the reason why it's showing a profit. And then they also have a new rental. The new rental is showing a loss, not a significant loss, but it is showing a loss. And so here they have $155,000 of total income, about 20,000, almost $21,000 of federal tax. So we said, we don't like this. Let's go get a cost segregation study on the new rental because bonus depreciation and accelerating your depreciation is all about the year you put it into service. It's that first couple of years that it's put into service. And so We needed to do it on the new rental. And that new rental was able to accelerate about $50,000, a little bit less than about $50,000 of depreciation. Instead of having that $33,000 of positive income, we're now showing an $11,000 loss, dropping that tax to almost $12,000. They're getting this $8,000 tax savings, and the next year, they're going to also have the tax savings. And then on the third year, you're going to see it really kind of drop off. It's going to be the last of it. And so it's a really nice thing. And we say, because my example was just showing it to you on the federal side. On the state side, you're going to get it as well if your state conforms. Not all states conform, FYI, to cost segregation studies. If your state conforms, you'll also get that tax savings. Cost segregation studies and bonus depreciation, all this stuff, you're not generating losses here. We're not generating deductions. We're just talking to your future self and we're saying, hey, future self, we want some of those deductions that you're going to have and we want them now. And so it makes it really, really nice if you want to grow, if you want to expand. So you take your tax savings. Okay, I had $8,000 in federal, then probably maybe 3,000, 11,000. That's not enough. But if I do it, if I have it over 3 years, now I take that tax savings. I go buy another rental. I do a cost seg on that second rental. And then I have more tax savings. I save for this, rinse, repeat, rinse, repeat. So the fact that you're pulling your depreciation forward is great, but you need to make sure that we're doing it for a purpose. We don't want to do it just so that we lower our tax and now we can go on vacation to Bali. Like, no, 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 no. We don't want to use the tax savings for that because that's just hurting yourself in the future. And yes, in the future, we're going to have, we lost that deduction because we used it. So we will have more tax that we need to pay. But again, we can deal with that because there are other strategies, and also, we've also just doubled or quadrupled our portfolio, which makes it really, really nice. If you're not planning on holding properties for a very long time, this is not the strategy for you because, again, we've depreciated it and depreciation has recapture. And so, when you try to sell something, we need to look on how you want to sell it because it can have really big tax hits. It works really nice for multifamily homes and then also commercial. That's just how the things are structured. You can see, of course, it does great for single family as well, but multifamily and commercial is really, really great for it as well. And when you're thinking about doing a cost seg, let me preface that we need to make sure there is a good amount of usable depreciation. And so you really want to, yes, you can do it on renovations, but we want to have at least $500,000 of for there to be a very large benefit to you. Now, after you've depreciated the property or you've had a property that's been around for a very long time and you're like, hey, I kind of want to get out of the property. I always say to people that are like, I want to sell everything, I want to get out. I always say, like, why? Why are we trying to get out? Sometimes it's going to be because they are tired of managing it. Maybe it's because you have moved to a different location. Maybe it's because you want to take that money and put it into something else that's even bigger. That's when I implore people to look at 1031s. A 1031 exchange is where you can delay that tax, right? I have a building that I have purchased. I've depreciated the crap out of it. Now I'm almost paying full capital gains tax on that property. And then I say, no, 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 no. I'm going to put those profits into a similar or like kind item. Doesn't always need to be property to property, just FYI. And you can delay that tax. You say, like, no, I don't actually want to pay the tax. I want to delay. And in the tax world, we always say, delay, delay, die. Because when you die with the tax bill, it goes away. It dies with you, and your beneficiaries don't inherit it. They actually get step up in basis, which is one of the best things ever. See this in the stock world very, very much. Step up in basis is where people, the basis of something is at the value of when somebody passes. So if I inherit a property from my parents and when they pass away, my basis is going to be whatever that value of that property is when they pass away, regardless of whatever they paid for it. So that's a really huge thing. And so this is one of the things why we say like 1031s are a really great option for people, and they're not so simple, because remember when people are trying to sell, we're like, why are you selling? And maybe you're trying to change states. Maybe you want something a little bit more local or something like this. 1031s can happen in all 50 states. You're not subject to having it just in one state. Maybe you said, hey, I want to sell because I want some of this money that is inside my rental. Okay, great. Let's take some of that money out so you can use it, and then put the rest of the money into another piece of real estate. That's totally an option. We call that boot. Boot is where you are actually not putting all the proceeds into the next property. It's where you're taking out some of those proceeds and you can use that for whatever you want. Let me give an example if we did a partial 1031 where somebody is taking boot. So here in this example, they were selling the whole thing. They've got 550 some thousand dollars of capital gains. That's 100 grand on federal tax. They're going to be paying state tax as well, but it's 100 grand of federal tax that they're going to pay on. And so they wanted to take some of the money out. We still had some basis, and so they wanted to take out 150,000. They still had some basis, so we're only paying capital gains on $100,000. That tax went from $100,000 to 15,500 and change, because now they're only paying tax on just that 100 grand. They get 150, and they still get an income generating thing. Like, they're still, it's not just over, right? They're still getting an income generating tool that they're able to use. Now, there are some really big important things that come with 1031s. And one of those biggest things is a timeline. People need to always follow the timeline because the timeline is very strict. There's been many instances where the government has extended time periods. Like, we here in LA, all of us got put on extension for the fires. There were no penalties, there was no interest. There was a bunch of COVID people got extensions for things. There's been a bunch of reasons that timelines have been extended, except in the 1031 world. That there's almost never a situation where people are able to extend that timeline. So, couple important dates: the 45 days and the 180 days. Once you sell your property, you have 45 days to identify three additional properties that you were wanting to buy into. You need to identify at least three. I always recommend people to put like a DST, Delaware Statutory Trust, as the third one. That's a completely passive property situation. You're like a point 0.5 or 2 owner in like a $300 million property wherever you want it to be. And so you still can get some revenue coming to you, just done on a quarterly basis, and you have absolutely no management because you're barely a drop in the budget of an owner of it. And so, as somebody that has bought several homes, it is sometimes a little difficult. Your ideas of what you want to go into might end up changing as you go further in the deal. And so you need to identify three properties within those 45 days. And then you also need to close on one of those three properties within 180 days of selling that first property. These two dates are really important: the 45 days and the 180 days. With As long as you can make sure, well, not as long as, but you need to make sure that you follow these rules. We always recommend that when people are doing these types of things, that they work with a professional. It's very much similar to even when people are like doing self-directed retirement accounts. Even with a self-directed retirement account, you do want an advisor with you. You do need a professional to help guide you through some of these things, because you're going to see just professional advice and professional stuff. And so when you're trying to do a 1031, we always recommend that you do it with an accommodator so you don't have a failed 1031. Okay, so these are just three examples of strategies. You can see that many different strategies can be layered upon each other, and then some of them could be done just by themselves. Some of them are short term, and then some of them are long term, going through things. but we just wanted to give some examples of what the options are. I know I was a little fast, but I really wanted to make sure that I had time for your questions. So hopefully I wasn't too fast for you
That
guys.
was great, Nicole. Thank you so much for all that wisdom and information. So many powerful
Sure.
strategies. Love it. We do have some. I'm going to start with the pre-submitted questions, and I see a few of those names in here. So we'll get to your question, and then we'll hit the chat right after that. But some of these you covered, but let's see. There's a couple maybe that we can get into more detail on, and some of these are very specific. So probably booking a call with Nicole might be the best idea for some of these. But here's one from Dave. We are buying a house for our adult special needs daughter in Washington State. It will be owned by her special needs trust. Question: if she sells the house, will the money be sheltered by the trust or will she have to pay capital gains?
So one is she's never going to ever be able to sell the house. Well, it's the trust that's going to sell the house because the trust is going to own it. The trusts do pay tax. Trusts pay tax. Trusts don't eliminate tax whatsoever. Trust does have a different tax rate than adults. If the funds are distributed, then your daughter can pay the tax at whatever her tax rate is, or the trust will pay the tax. But if there is capital gains, there will be tax to be paid, whether the trust is paying the tax or your daughter's paying the tax.
And I think you answered this question, but just to make sure, Eric, who is a client of ours, is asking if someone works as a full time veterinarian, but also qualifies as a real estate professional, can they use the rep status to offset their veterinary income?
Absolutely. They absolutely can. I would just make sure that it's clear on how things are set up. I would implore the use of LLCs and an S Corp to make sure you can help identify very clearly the real estate so that you can show real estate hours and then you can show also the amount of income. Because if you're a full time vet and also qualified for real estate professional, like, how are we showing that? But you can because there's many people that have jobs and also qualify for real estate professional. And then yes, that money, that those losses will offset your debt or whatever your vet income if it's W2 or Schedule C or whatever it is. S corp.
Yeah, great. Thank you. Can you please explain? This is from Yusria. Can you please explain qualified business income and how bonus depreciation can be applied to this?
So qualified QBI has been around for years and years and years and years. And it is the ability, the government is going to just give an extra deduction depending on how much you're paying in self employment tax or payroll taxes. Self employment and payroll taxes are the same thing. Depending on how much you're paying in self employment tax and income tax, they will give you an additional deduction. This has nothing to do with bonus depreciation. It is just a deduction for business owners. You need to own a business for this. Depreciation is when you purchase an item that expense of the item is spread out over a period of time. And taking bonus depreciation and QBI, they're not going to interfere unless it's now showing you as a loss, and so then you're not going to qualify for QBI because if you have a loss, you don't need an additional deduction.
Right. Barbara's asking, I am recently widowed and want to know the pros and cons of holding on to real estate or selling it. What is best for me? What is best for my heirs? This is one of those very specific situations.
So what we do generally when people inherit things, we generally recommend people to sell. Like we generally recommend to sell because it helps eliminate some of the emotional attachments. And so for your heirs, they will be able to get step up in basis. You also got a step up in base, probably got a step up in basis. So if you and your spouse own the property 50% and then your spouse passes away, you would get step up in basis for half of the properties that you guys owned. And so if you did decide to sell, your tax would be greatly reduced because you have step up in basis, but you are then removing that from your heirs. And so I would look at, why are you trying to sell? Like, is you don't want to handle the real estate anymore, or just we're thinking about selling and you want some of the proceeds, I would see like what is the actual reason about why you want to sell, because there might be some other ways that you could go about it, or selling partial, selling, there's some other things that might be beneficial for you, as opposed to just selling everything outright. But if you want to get more into specifics of things, we can kind of run some numbers. If you just send an email, we can set it up. A chat.
Thank you. And then there's a few on here that are similar in nature as far as like very specific best strategies for retirement and keeping or getting out of real estate as an example, which is similar to that question you just answered. Yeah, a few of these just reach out. So Phil, James, Scott, you're asking some more very specific kind of self-directed type questions that I can answer, but these are also getting on into the realm of financial advice as far as like financial planning type advice, which I'm sure Nicole would be happy to talk through, but they're not really specific to taxes per se. Let's move to the chat. Okay, Stan, business owner, landlord, solo 401k, business already does bonuses into 401k loans for real estate. Okay. Looking for advice on extreme. This is another one of those. Looking for advice on extremely low risk investment for 401k holdings. I'll let you answer however you want, Nicole, but just as a blanket statement for everybody here, Sense Financial provides the plan, we provide the vehicle, and the client invests. We don't get directly involved in investments or providing financial advice. So, just in case that type of question ever comes our direction, if you tell me you want to invest in real estate multifamily, I can introduce you to some people, but I'm not going to provide financial advice. That's kind of where it stops. So, anything to add, Nicole, on that?
Would just say that using your 401k to invest in different things beyond like the traditional like managed like whatever, I think is a really great strategy for people, but they need to be very comfortable about the thing that they're investing in. And what you might call low risk is not going to be the same that I call low risk. So you need to kind of understand the ins and the outs. That's same thing what we say about the about tax strategies. They're all things have their different levels of risk, and you just need to understand what your measurement is of low risk, because people think real estate is very, very, very low risk. And I know quite a few people that have been greatly burned and would never want to do real estate again. They're like, "Oh my god, it's the worst."
Uh,
And then, there's me, like, it's really kind of each to their own. It's like, what flavor ice cream do you like?
isn't
And
that true?
also, I'm gonna also end it on, you do need to take some risk too. So, we do need to take some risk, to risk and reward here.
Yeah, there's a balance. I think a
Exactly.
part of the point of self-directing is that you get to self-direct. And the whole idea is if you invest in what you know, understand, and can control, it's going to be safer for your retirement plan and you're going to have a more predictable outcome. And I always say when two people sign on the dotted line for what the terms are on a private loan or what the lease agreement looks like or whatever it is, that's more control than you can often get by just putting your money into the stock market. And this isn't to dog the stock market. I have plenty of money in the S&P and all this other stuff in Vanguard, Fidelity, and other places. There's nothing wrong. This is a and, this is not a either or. So anyway, okay. Question after that is, let's see. I think we know the answer to that. Since you have 64 properties, do you have to show 750 hours participation for each property? So how does that work when you have multiple properties and you're doing the tax return? It's obviously it's just the individual person, but
Yeah, so you can link, and so you can tell the government to look at all properties as one. So I can claim real estate professional for, well, I don't actually qualify for real estate professional, but I can claim for every property to say like, hey, because I spend hours here, 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 and here, like on all the properties. Like doing it all for one property, absolutely not. You can bundle all of them together, or bundle some of them, because like if you have a management company and let's say you have 5 rentals, but you have a management company managing all 5 rentals, how are we showing real estate profession, how are we showing the 750? Because you're not managing the rentals. So it's like now we need to actively show it with you trying to find new rentals or something like else there. But it's looking at that because like I manage some of the rentals, I don't manage them all, but I can bundle them.
Does acting, Stephen is asking, does acting as a private money lender to real estate investors as real estate work count toward the third requirement? Maybe you know what that means.
Yeah, it does. It does. As a private lender, one, love when people do this. I think this is one of those really underspoken about. Sorry for my grammar. It's one of these things that is not highly talked about, but very, very good strategies for people to use. But yes, that absolutely can count as real estate as long as you are doing it. In this case, we would probably prefer you to do it through an LLC or an S corp or something like that, where you're able to show like, hey, I have full ownership of the business. But yes, that can absolutely count for the majority of time and the majority of income. I know you were just worrying about it for the majority of income, but it also does time as well.
All right, 1031 in 50 states. How about US Virgin Islands?
Actually counts too. Yes,
Here you go.
all U.S. properties or U.S. said owned properties.
Can the interesting. Can the solo 401k be converted to a Roth solo 401k? Yes, it can. Talk to your tax advisor before you do it because that will add to your earned income for the year.
Yes, definitely will, but you can do it in stages as well to make it very, very nice.
Indeed. And then Dan is asking, how do you bundle multiple properties to show 750 hours? This is like a detailed question. Is there a form to file for it? I think
It
that
depends how
question
you're set
just came
up,
in.
but yeah, it's just an election that you can make, but it depends how you're set up. That I would need to see your return.
Got it. Yeah, let's that's all the questions, but just to hit on the Roth conversion piece a little bit more, because that's a rabbit hole that I love to go down because more Roth equals more tax-free ATM withdrawals when you retire. But basically, you know, Selena, you've probably heard me talk about this in other webinars. The solo 401k and checkbook IRA for that matter is a great vehicle to do Roth conversions in. Solo is easier because it has Roth and traditional built into the same plan. So you don't have to do any retitling of assets or anything like that. But the point is you can get really creative with Roth conversions and you can convert cash or you can do an in-kind conversion, meaning you actually convert the asset. So if I make a $50,000 contribution for 2026, I do a $50,000 first lien against a house loan, first trust deed position, second, it really doesn't matter with that 50. But the contribution was traditional, right? Pre-tax. I'm reducing my taxable income through that contribution. That's a traditional asset. When I distribute that money, not just the principal, but the returns from that investment at retirement, it's going to be added to my taxable income. If I convert it to Roth, of course, it's not. But instead of converting the cash, you can actually convert the asset. So I can go to a company, get a third party valuation appraisal. They'll give me a value for this $50,000 trust deed. It usually comes in at some kind of discount because it's illiquid. There's a lack of control. It's inside of a retirement account. And because of that, it comes in typically 10 to 25% discount. It can vary, but you convert the whole 50 at less than 50, right? So instead of adding 50,000 to your earned income for that entire conversion, you might add 35 or 40,000, right? So you're doing it at a discount. Now, when you convert that, it's now Roth. And now all the returns and the principal is after tax type money. So when you do take a distribution at retirement, then it's tax free. The other aspect to this, and I'll shut up and let Nicole add anything she wants to in a moment. The other aspect to this that it's important to know is you can do this in stages, as Nicole mentioned, so you're not incurring a bunch of tax in one year. However, each Roth conversion that you do each year has its own separate 5-year rule. So you can't touch the principal converted until at least 5 years. It goes back to January 1st of the year of the conversion. So 5 years later, you can take a distribution. That doesn't matter if you're under 59 and a half, over 59 and a half, that 5-year rule still stands. And so it's a separate 5-year rule from the making the initial contribution to a Roth 5-year rule. That's a separate thing. And I apologize if I'm losing people here, but it's a really powerful way to get more money in your Roth by not just making straight Roth conversions or converting Roth traditional cash, but actually converting an asset at a discounted rate. So anyway, I had to go on that tangent. So anything to add on that, Nicole? And I think we'll wrap it up with this.
When I doing planning for people that are doing conversions, one, if you're thinking about doing a conversion, you need to speak with your tax advisor for sure, because there are definitely really great strategies that can help with the tax beyond outside of the real estate stuff. There's like conservation easements, there's fee simples. And so sometimes it might be better to bundle all that you want to convert and do it in one go. And sometimes it might be better to do it in different stages. You just need to understand how much do you want to do at the end? What is that total amount that you want to do at the end? And then you can decide which year makes the best sense tax wise. Because there's a couple of things that I just did last year, even with a client that they did a huge $1 million conversion, and we were like, okay, cool. But they paid lower tax with that conversion than they would have if not, if without anything.
Love it.
Yeah.
Love it. Yeah. And losses, personal losses can offset some of that income being added to your tax return too. So yeah, definitely talk to your tax advisor before you go down that path.
Yeah.
Nicole, I'll give you the last word. Thank you so much for being here.
Thank you for having me. We really enjoy coming to these types of things. If you guys have additional questions, please feel free to send us an email, sign up. We can definitely assist.
Yeah. And sorry, I guess I lied. You're not going to get the last word, but we've had a partnership with Robert Hall and Associates here at Sense Financial for many, many years. Clients have gone both directions, and they've been a great partner of ours. So definitely, they can help people around the country. They're not just restricted to any specific state. So if you're looking for tax help or somebody to help you file each year, planning, whatever it comes to, definitely reach out to Robert Hall and Associates. Get on Nicole's calendar, email her directly. They're a great resource.
Perfect.
All
Thanks
right.
so much for having
Thanks,
us.
Nicole. Enjoy soccer.
Bye.